During the first days of August 2024, the yen surged from 162 to 144 per dollar, an appreciation of 13% that helped trigger an abrupt unwind of the yen carry trade. The resulting forced selling contributed to a 12.4% plunge in the Nikkei index on August 5th, its worst one-day fall since 1987. When Wall Street opened, the Nasdaq fell 6.3%, and Nvidia opened 14% lower. The VIX briefly approached 66, while selling spread across stocks, bonds, and cryptocurrencies. Markets recovered quickly, but the episode demonstrated how a sudden rise in the yen could destabilize global markets. A similar disruption could happen again during the weeks ahead. The yen recently approached 164 per dollar, prompting Japan and the United States to intervene jointly to strengthen it. The yen remains weak because U.S. interest rates are considerably higher than Japanese rates. If U.S. rates fall while the Bank of Japan continues tightening, that interest rate differential could narrow rapidly. The yen could then strengthen sharply, once again forcing yen-funded carry trades to unwind and inflicting very heavy losses across numerous asset classes around the world. Therefore, this is an important time to understand the current stance of Japanese monetary policy and how it has evolved over recent years. In June 2018, MacroWatch produced a two-part series explaining Japanese monetary policy. Part 1, the BOJ's radical experiment, covered developments from 1999 to 2012. Part 2, the BOJ goes ballistic, covered the much more aggressive policies introduced from 2013 through June 2018. This presentation begins where those videos ended and brings the story up to date. This chart shows the inflation rate in Japan from 1960 to 2018. Beginning in the mid-1990s, Japan repeatedly slipped into deflation. For the next 2 decades, the annual rate of inflation was negative more often than it was positive. Since deflation discouraged spending, held back economic growth, and increased the real burden of debt, the BOJ introduced increasingly aggressive policies to end it.